Money does not leave a bank all at once anymore. It leaves slowly. First, people stop believing the numbers. Then they stop believing the statements. Then they stop believing the promises. By the time the doors actually close, the failure already happened months, sometimes years earlier. Most people just did not notice it. That is the uncomfortable part. Modern bank failures do not start with panic. They start with silence. Most people think banks fail when something dramatic happens. A crash, a headline, a sudden run. That idea comes from old images, long lines, shouting, police outside branches. But that is not how modern financial systems break. Today, the system is designed to avoid visible panic at all costs. It stretches problems out. It hides stress behind technical language. It replaces sudden collapse with slow erosion. What looks stable on the surface is often just losing trust underneath. Trust is the real currency of banking. Not cash, not reserves, not even capital ratios. Those are numbers. Trust is belief. Belief that deposits will be there tomorrow. Belief that payments will clear. Belief that the system will function when it is needed most. When that belief weakens, nothing breaks right away. Things just start moving more slowly, quietly, almost politely. At first, the signs look harmless. A bank offers slightly higher rates than others. It relies more on short-term funding. It talks more about liquidity management. None of this looks like failure. It looks like adjustment. Analysts explain it away. Regulators call it manageable. The public hears nothing. But inside the system, something important has already changed. Counterparties become cautious. Large clients reduce exposure. Risk managers shorten timelines. Trust does not disappear. It thins out. This is where most people misunderstand what failure looks like. They expect a moment, a single event. But institutions do not fail in moments anymore. They fail in phases. Each phase looks reasonable on its own. Each step can be justified. Together, they form a slow retreat from confidence. Under the surface, banks are deeply connected to each other. They lend, they borrow, they clear payments. They depend on shared assumptions. When one institution becomes even slightly less trusted, others respond quietly. They ask for more collateral. They shorten lending periods. They price risk differently. No announcement is made. No warning is given. But the system becomes a little tighter. This tightening does not show up on the evening news. It shows up in balance sheets, in internal emails, in funding schedules. A bank that once rolled its obligations easily now has to work harder. It still functions. It still reports profits. But its margin for error shrinks. Every decision matters more. Every shock hurts more. Central banks are aware of this process. They monitor it constantly. Their goal is not to prevent failure completely. That is impossible. Their goal is to prevent visible loss of confidence. Because once trust breaks publicly, it spreads fast. So they act early, quietly, through back channels, through special facilities, through technical support that sounds boring but carries weight. This is why modern crises feel confusing. Officially, nothing is wrong. Unofficially, everything is being managed carefully. Support is framed as routine. Emergency tools are renamed. Temporary measures become standing facilities. The language stays calm. The tone stays controlled. The message is always the same. The system is resilient. But resilience today often means delay. It means buying time. It means smoothing the decline. Instead of allowing weak institutions to fail quickly, the system absorbs stress gradually. Losses are spread out. Problems are rolled forward. The visible structure remains standing. The internal strength fades. Banks adapt to this environment. They learn that survival depends less on strength and more on perception. As long as confidence holds, operations continue. As long as markets believe, funding flows. This creates a strange incentive. Protect appearance first, solve problems later, or never fully. Over time, this behavior becomes normal. Management focuses on communication. Regulators focus on stability metrics. Everyone focuses on avoiding shock. No one wants to be the person who triggers panic by telling the full truth too early. Delay becomes the safest option, even when it increases long-term risk. For ordinary people, this process is almost invisible. Deposits still show up on screens. Cards still work. ATMs still dispense cash. Life goes on. But the system behind these functions becomes more fragile, not because of a single bad decision, but because of accumulated hesitation. The real danger is not sudden collapse. It is slow normalization of weakness. When stress becomes routine, it stops feeling urgent. When support becomes permanent, it stops being questioned. A bank that depends on confidence alone can survive for a long time, but it cannot rebuild trust once it is gone. Trust, once damaged, behaves differently than capital. Capital can be raised. Trust cannot. It only exists when others believe without being forced. The moment belief requires explanation, it is already fragile. The moment reassurance becomes frequent, confidence is already thin. This is why banks today rarely fail overnight. They drift. They lose flexibility. They become more dependent on external support. They function, but only under certain conditions. And those conditions become stricter over time. People often ask why warnings seem late, why problems appear suddenly after years of calm. The answer is that the system was changing quietly the entire time. The warning signs were not dramatic enough to notice. They were technical, procedural, easy to ignore. By the time headlines appear, trust has already moved elsewhere. Large players have adjusted. Exposure has been reduced. Risk has been shifted. What remains is the visible event, not the real failure. And that is the unsettling part. The most important changes in the financial system now happen before anyone feels afraid. They happen while things still look normal, while institutions still speak with confidence, while stability is still the official story. This does not mean collapse is guaranteed. It means that when failure comes, it will not feel sudden to those inside the system. It will feel overdue, managed, almost expected. The public, however, experiences it differently. For them, the story changes all at once. Trust that seemed solid suddenly looks fragile. Assumptions that felt safe suddenly feel uncertain. The gap between perception and reality closes quickly. What matters most is not when a bank fails, but when people stop believing it cannot fail. That moment rarely makes the news, but it reshapes behavior quietly, and once that shift happens, it cannot be undone easily. This is how modern banking works now. Failure without drama, decline without noise, confidence fading before anyone says the word crisis. When trust weakens inside a financial system, institutions respond in predictable ways, not publicly, internally. The first response is always control. Control of information, control of exposure, control of expectations. Banks reduce what they share. They simplify what they report. They focus on metrics that still look strong and quietly move away from those that no longer do. This behavior is not illegal. It is not even unusual. It is defensive. Institutions are built to survive, and survival in a confidence-based system depends on limiting doubt. So language becomes carefully managed. Risks are reframed. Temporary pressures are described as structural adjustments. Problems are never denied, but they are never allowed to feel urgent. Regulators understand this dynamic. They are not outside the system. They are part of it. The role has shifted over time. It is no longer only about enforcing rules. It is about maintaining continuity, avoiding disruption, preserving function. In a world where systems are deeply interconnected, a single failure can cascade quickly. So regulators learn to tolerate weakness as long as it remains contained. This is why enforcement often looks slow, why warnings come late, why action appears delayed. It is not always because regulators are unaware. It is because early action has costs. It can trigger reactions they cannot control. Once confidence breaks publicly, it is very hard to restore. So they wait, they monitor, they intervene quietly. They hope time will solve what decisive action might worsen. Over time, this creates a pattern. Institutions learn that delay is rewarded. Markets learn that support will arrive before collapse. Risk shifts from being eliminated to being managed indefinitely. This does not remove danger. It changes where it sits. Instead of banks absorbing losses quickly, losses are spread across the system. They are pushed forward, rolled over, absorbed through inflation, low returns, or reduced purchasing power. The system stays upright, but it becomes heavier, less flexible, more dependent on continued belief. For ordinary people, this shows up indirectly, not as a banking failure, but as a feeling of stagnation. Wages that do not keep up, savings that grow slowly, housing that becomes harder to afford, credit that feels tighter even when rates are stable. These are not accidents. They are symptoms of a system preserving itself. Banks that cannot fail suddenly also cannot reset easily. They carry old decisions with them, old exposures, old assumptions. Instead of clearing the slate, the system layers new rules on top of old problems. Complexity increases, transparency decreases. Fewer people understand how things truly work. This creates distance between institutions and the public. Trust becomes abstract. People rely on systems they do not understand because they have no alternative. Confidence is no longer emotional. It is functional. Things work, so belief continues. Until they do not. The most fragile point is not when deposits leave. It is when participation changes, when businesses choose different partners, when investors demand higher compensation for the same risk, when households become cautious, not because they are afraid, but because they feel uncertain. This slow withdrawal of engagement matters more than sudden panic. Banks notice this first. They see changes in behavior long before statistics catch up. They respond by protecting margins, reducing risk appetite, passing costs along. Each decision is rational. Together, they tighten the system further. At this stage, policymakers often speak about resilience, about buffers, about stress tests. These tools are real. They help. But they also create a sense of control that may not reflect reality. Stress tests are designed around known scenarios. They do not measure belief. They do not capture trust. They assume cooperation continues. But trust is not contractual. It cannot be enforced. It exists only as long as participants choose to stay. Once enough participants quietly adjust their behavior, the system changes shape. It still functions, but differently, less generously, more cautiously. This is why modern crises feel like exhaustion rather than shock. The system does not break. It slows. It becomes less responsive, more fragile to small disturbances. A minor event causes outsized effects, not because the event is large, but because the system has no slack left. People often ask why support measures seem permanent, why emergency tools never disappear. The answer is simple. Removing support would reveal how dependent the system has become. Stability now requires continuous management, continuous reassurance, continuous intervention. This does not mean collapse is imminent. It means normal has changed. And normal now includes persistent fragility. Institutions function under conditions that would have been considered unhealthy in the past. But because failure is delayed, the cost is less visible. The risk is not a single event. It is accumulation. Each year of delayed adjustment increases dependence. Each cycle of support reduces flexibility. Each avoidance of loss makes the next loss harder to absorb. For households, the effect is subtle. Financial decisions feel heavier. Mistakes feel more costly. There is less room to recover. The system no longer absorbs shocks for individuals. Individuals absorb shocks for the system. This is the quiet transfer that rarely gets named. Risk moves downward, from institutions to people, from balance sheets to daily life. Not through policy announcements, but through lived experience. Banks that do not fail suddenly survive longer. But survival is not the same as health. A system can function while becoming less supportive. It can remain stable while becoming less fair. These changes do not trigger alarms. They do not violate rules. They just redefine expectations. Over time, people adjust. They lower assumptions. They accept less. They plan more cautiously. This adaptation keeps the system going, but it also locks in fragility, because resilience now depends on restraint. The danger is not that people panic. It is that they stop expecting better. When confidence becomes minimal, growth slows. Innovation retreats. Risk-taking disappears. The system remains intact, but stagnant. This is why slow institutional failure is so difficult to confront. There is no moment to point to, no clear villain, no single decision to reverse. Everything happened logically, carefully, reasonably. By the time questions become unavoidable, options are limited. Trust cannot be rebuilt quickly. It requires time, transparency, and acceptance of loss. All three are politically and economically costly, so the system continues as it is, managing weakness, avoiding shock, preserving function, until conditions change in ways that cannot be smoothed over. When that happens, the failure will not feel sudden to those who have been watching closely. It will feel like the end of a long process, one that began quietly, without panic, without headlines. Most people will only notice when the gap between expectation and reality becomes impossible to ignore, when systems that always worked start working differently, when assumptions no longer hold. By then, trust will not collapse, it will already be gone, and the system will still be standing.